Good morning. It is Wednesday, May 27th, and this is another episode of the Market Commentators, a podcast brought to you by the Milwaukee Company. My name is Matt Salm. I'm an investment analyst at the firm, and joining me this morning is Andy Wilms, President and CEO of the Milwaukee Company, and Mike Wilms, who also serves on our wealth management and portfolio strategy teams. A quick reminder that nothing in this podcast should be taken as investment advice. And with that, Andy and Mike, good morning.
Morning, Matt.
So usually we start off the podcast with a quick recap of what's happened in the markets. And there were some dramatic moves yesterday. So Andy, do you want to tell us a little bit about that?
Well, let's, stocks continue to surge in the face of some of the worst economic data in our lifetime. If we look back to last week, we saw the markets really surged at the beginning of the week over optimism regarding the reopening of the economies and some positive news about progress on vaccine trials. And then later in the week, they slow down a bit as there's more geopolitical tensions with the U.S. and China beginning to impose new security laws on Hong Kong. And there was a Senate bill that would introduce to force Chinese firms from being delisted from U.S. exchanges to some extent. And the markets were, of course, then this week, the markets were, of course, closed on Monday, but they really surged yesterday as investors continue to place bets on the successful opening of the economy and the development of a COVID-19 vaccine. I mean, at this point, the S&P has now recovered more than 60% of the losses it suffered as a result of the coronavirus pandemic. So the market is certainly taking a much more optimistic outlook on this what's going to be happening in the future than it was a couple of months ago. That's for sure.
Yeah, and like you said, this is in the face of some of the worst economic data of our lifetime, which can make it particularly puzzling in some ways to make sense of what's going on. The market's obviously forward-looking, and it's pricing in, a good recovery, but it's still it causes me a little bit of whiplash. I don't know how you guys feel looking at economic data and market data side by side.
Well, looking at market data relative to what's happening in the economy, there's a huge disconnect. But with your observation about the market being forward-looking, we're looking for probably the most substantial GDP drop as far as economic statistics go in the second quarter. Once those numbers start coming out in the early part of July, but they're also projecting some of the largest GDP growth numbers for the third quarter, where a number of well-known, pretty successful economists are predicting the economy to the recession to end after the second quarter, with growth restoring as the economy reopens in the third quarter.
And this morning, when we look at the futures, we're recording this early Wednesday morning, the market was set for a very strong open. And that's, I think, in response to a technical indicator that a lot of investors follow. That is the 200-day moving average, which the S&P crossed briefly yesterday. So the 200-day moving average is simply the average of the closing level of the S&P's last 200 sessions. So now yesterday it was above that 200-day average. And the Dow Jones also, crossed over the 25,000 barrier yesterday and finished with a gain of over 2%. So, I guess in my view, it's kind of a precarious rebound, but for the time being, it looks like the market's on track to continue its rise. But that could change at a moment's notice too.
One piece of information could reverse the whole process, no question.
Exactly. And that news probably would relate to COVID-19. And Matt, I know you're going to tell us a little about what's happening there. Any new developments?
News on the COVID front. There's a Maryland-based biotech company called Novavax that has started its testing of its coronavirus vaccine at the human clinical trial level now. And one article I came across said there are now at least 10 vaccines that are in clinical trials, and there's over 100 other vaccines in preclinical development. So the pace of research on that front continues to be furious and fast, and that's great. But of course, science is not necessarily known for being the quickest thing in the world as well. So it's great that there are a lot of people working on the problem. But I would think the term cautious optimism is about as bullish as I would be.
I believe that and it might sound like a small number relative to the total in the Washington response to the virus, but I think there's $1.4 billion worth of cash earmarked to fund the vaccine and treatment research.
Well, I don't know if you saw this, Matt, but the daily change in U.S. COVID-19 deaths fell to a 2-month low on Monday, which I thought, that's obviously, what we're looking to see. But at the same time, we all saw the news of what would happen on Memorial Day throughout the country where, crowds got gathered. People weren't really totally abiding, or a lot of people totally disregarding, I should probably say, the social distancing suggestions. So this will give us a good insight as to what the risk is really going to be. I mean, you don't want to, you'd hate to do it this way. Never advocate, okay, everybody get together on Memorial Day so we can see what happens over the next 2 weeks, right? But if we do not see a significant spike as a result of even given all the crowds and the get-togethers during the Memorial Day weekend, then that I think will be a very positive sign, but not a definitive sign, because even if that doesn't happen, we have to take into fact that there might be that might be more a result of the seasonal aspect of this, that maybe the virus really doesn't spread as nearly as quickly or easily in warm weather. But we're not going to be warm forever, as all of us up in Wisconsin know.
Exactly.
So you can't put your guard, even if the cases don't spike, we still should keep our guards up. Be prepared for a future spike in the fall and winter, which of course we hope don't happen. But so we could see a bull market throughout the summer months, right? Just like we had all through. It's important to remember all through before this started. We had a great bull market going on until it wasn't when this started hit. If we had a repeat of what we experienced in last winter, I think the market would be in jeopardy, because we're getting very close to the valuations we were at when this thing hit in the first place.
Absolutely. And I think one other thing that you talked about at the start, and I also wrote about it in our newsletter last week, was I think rising tensions between the U.S. and China. The risk of the phase 1 trade deal being derailed, but just generally the fact that animosity seems to be growing between the two countries. And it's worth remembering that alone could trigger a significant sell-off in the market.
Right. Yeah.
Well, it'll be interesting to see, to that point, if there's follow through here with some of the comments that Xi Jinping made yesterday relative to Hong Kong and military preparedness. There's an elevated level of tension that just seems to keep growing between the U.S. and China.
Which, as Matt pointed out in the newsletter last week, and you just mentioned, that's a whole different risk factor that investors need to keep in mind as the market continues to rise.
You want to move over to the economic front, Mike?
Sure. In terms of the economic front, I think we talked about a little bit amongst ourselves the difference between the initial unemployment claims that are front and center in the media versus the total number of people that remain on unemployment. And there's a divergence between initial unemployment claims when somebody is initially laid off, and then as the economy starts to reopen and people are called back to work, what the media has been reporting is the aggregate number of weekly unemployment claims and keeping a running total without recognizing the fact that some of those initial unemployment claims going back to the beginning of March and beginning of April, those folks are actually being recalled to work. So where the total unemployment claims, initial unemployment claims had reached 39 million and change, the number of people that remain unemployed is closer to 24, 25 million. So, it's one of those cases where you need to make sure you're paying attention to the right statistics. The bond market has started to respond very on a small basis. Long-term yields have trended up a little bit versus short-term yields. The yield curve is steepening. That's normally an indication that there's an expectation for the economy to be improving. So, I mean, it's a hopeful green shoot. Consumer confidence did jump more last month than expected. It came in at 86.6 versus an expectation of 85.7. I can speak to, I did experience some of the complete disregard for social distancing in Lake Geneva on Memorial Day. It's like everybody had streamed over the border from Illinois, and it was business as usual pre-COVID-19. So given an opportunity, I think the consumer will come back.
I would ask what you were doing in Lake Geneva, but I want to keep this as a G-rated program, so we'll skip that. But I will point out that home sales, also topped estimates, and now housing demand has actually surpassed pre-crisis levels at the present time. So it's very interesting. I have a son who's in the housing market right now. He's looking for a new home. And, he's finding it's very difficult to go look at something because they don't open houses and people are afraid to let you to get in, and understandably so. And, if you're living there and have strangers come through your house, that causes a lot of angst in terms of, virus. So the demand is there, but the supply is still, being constrained by the virus. So I think the number of transactions is going to be influenced by that.
No question.
Moving on to the individual investor focused, portfolio management side of the show. I know we've talked a lot already today about why we think the stock market has been climbing so much recently, but there are some other theories out there. Do you want to explain a little bit, Andy, about some other ideas people have about why money's piling into the market?
Well, there's Ben Carlson wrote about this in his terrific blog, which I highly recommend, called A Wealth of Common Sense. But he wrote about the fact that what he referred to as bubble-like behavior by a crowd when they're usually running for the exits, right? And watching Squawk Box this morning, there was a rather fiery debate between two of the the hosts of the program. Actually got in a little bit of a shouting match over what is driving this, and with one arguing that all you naysayers just can't accept the fact that the economy is doing well and our president's done a great job in managing this, and the other guy arguing that's not the reason that things are doing well. It's just a matter of people are over exuberant, and there is some reason to believe that Mr. Market's gotten Mr. Market, as we call the collective stock market, is getting away from himself. And one of the things is that you have so many new people entering the stock market. The number of new accounts that are being opened is at a record's pace. And there's a lot of reasons for that, right? You have free trading. That's, I think, a contributor. You have this the fact that people like a bargain, people are at home more, so they're thinking more about their finances, and so they're devoting time and effort to things that they normally just never think about, unfortunately. And then there's also the fact that people like to gamble. There's a huge percentage of our population that likes to gamble, and the casinos are closed, and there's no sporting events to bet on. So people have started to migrate into the stock market as a place to place a bet on, get a little action on this. The reason this is concerning to me, I'm not saying this is a huge factor, but it's just, I think it could be a significant one. And the reason I think this is something we got to keep in mind, along with the China situation and the COVID-19 situation, is because these are not dedicated investors, right? These are people who got into it more as something to fill the day. And so when things, yeah, exactly. Thank you. And that's exactly what you're going to be facing, is if the market starts to show any sign of weakness, these people are going to be getting out as fast as they got in. So,
well, and I don't know if you saw the announcement, but the Nevada governor is allowing the casinos to open in Nevada on June 4th.
So that might be that might be bearish for the stock market, because people will be pulling money out to go play the slots,
or sports betting and whatever else goes on out in Vegas.
So I think there are some of these things that don't necessarily come to mind that are contributing to the market, and I don't know how stable those contributing factors are and how much we can count on them for the long term. So again, a lot of this boils down from a portfolio management perspective to what your objectives are and what your time frame is. If you're really trying to preserve wealth, if that's really your goal, then in my mind, this is a time to maintain sort of what I would call a risk-off posture. That's not to say you shouldn't be in any equities, but if wealth preservation is your primary focus, then probably underweighting equities makes a lot of sense here, because for all the things we've talked about, there is a significant risk. And if the market goes up, that's not a problem for you if you're in wealth preservation and you have only 20 or 30 or 35 or maybe 40% of your portfolio in equities. But if you're in wealth creation mode, like yourselves and other young investors, then I think
young.
What's that?
Are you calling me young?
No, I didn't mean to suggest that. I was referring to Matt. Sorry.
Oh, okay. I just clarifying.
You're older than me, so how young can you be?
Notice how I picked up on that.
Yeah, I sure did. Back to Lake Geneva, I think. Anyway, the point being that if you're a young investor, or if you have a long time frame, or you're really looking to grow your portfolio, that's your focus, then remaining consistent in your equity allocation makes a lot of sense, because even if there's a big correction, it won't be a problem for you. You've got a 5 or 10 year investment horizon, and so you want to stay invested for the duration.
Absolutely. I think that makes a lot of sense. And like you said, we don't know how much of a contributing factor some of these other causes are, but they are just reasons for potentially heightened level of concern. Well, thank you everybody for listening this morning. As always, if you have any questions or any topics you would like us to discuss, please reach out at firm@themilwaukeecompany.com. And yeah, we would love to hear your questions and use that as material for future episodes. We also, as we've talked about, publish a newsletter every single week. Andy has a column in it. I have a column, and a few other people at the firm have columns as well. So we talk about issues sometimes similar to what's on the podcast, sometimes completely different. Last week, Jim Paserno talked a lot about gold and the role that gold might play in an investor's portfolio. So if that's something that you might be interested in, definitely check out the newsletter. And we're on Twitter as well, @TheMilwaukeeCo. So please consider following us there. And with that, Mike and Andy, thank you so much for joining.
All right, thanks, guys. Have a good day.
You too. Thanks.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented